Forex trading is super easy, but you must first understand the language of the market. And these things that I'm about to review to you right now are what the traders in my mentorship community are applying to make a lot of money from the market. Hello, everyone. This is Ageless. All right, let's dive straight into it. But before then, if you haven't subscribed to this YouTube channel, you just have to do that as fast as possible. All right, you can do that right. So this is it. When price takes liquidity, what happens? What happens when price takes liquidity? And it is very important for you to understand this particular concept because it's going to help you a whole lot in your forex trading journey. You understand? The reason why most traders, why they struggle with making profit is because they do not understand the language of price, the language of the market. That is why they struggle. They don't know when price gets to a particular level, what price does and what price eventually do and all of that. But this very moment, I'm going to be revealing a whole lot of things to you. So I want you to pay rapt attention to all of these things because by the end of this video, you are going to be what? Highly profitable with these strategies that I'm going to what? That I'm going to be revealing to you. Now let's take a look at it now. Now, what happens when price takes liquidity? Now look at this. As you can see, I have mentioned it several times without number that what price usually form a leg in the market, which is called what? Fair value gap. Can you see? This is a bullish fair value gap, right? Now, a bullish fair value gap, what it does is that it acts as a magnet, and when price comes into it, it also acts as a rocket. It projects price upward, right? Can you see it? Likewise, when you have a bearish fair value gap, it does the same thing. Now, when price is when market is open, what price does is that it chases liquidity. Price usually goes after what? Liquidity. Now, let's just assume that this is what? A liquidity point. Your liquidity points are your what? Your swing high and your swing lows, right? Or probably old highs, old lows, right? Now, fine. Now, what is liquidity? Liquidity simply means what? Money. Money resides here. Okay, so when smart money traders, when they are trading, what they do is that they chase after liquidity, they chase after money. There is a whole lot of money here, and this is where the price is right now. So what price will do is that price will what? Move straight to what? To peak liquidity. Now the topic I'm treating now is that what happens when price takes liquidity, or you can also reframe it that what happens when price grabs liquidity. Please, I want you to pay attention because this is going to help you a whole lot. Now, when price takes liquidity, there is something that happens in the world with price, or there is something that happens in the market. What it does is that after it takes liquidity, after it has tapped liquidity, can you see? Can you see this price now is moving towards liquidity? Now, the moment it gets to the liquidity point, most often it usually what? Reverse. You understand? It usually retraces deep into what? Back into a fair value gap on the way. You understand? Now let's take a look at it now. So what happens when price takes liquidity? So price does two things. First is that it either sweep the liquidity or it runs liquidity. When we are talking about liquidity sweep, it simply means that look at this price. When price gets to this liquidity point, you understand, it pays the liquidity here, it pays the money here, then it will now retrace back. You understand? That is called what? Liquidity sweep. Now, for liquidity runs, it simply means that when price gets to this point, it does not what? Retrace back. It continues to what? To move. You understand? In the direction, it continues to move upward. That is called what? Liquidity run. After it has grabbed liquidity, it continues to what? To run. That is called what? Liquidity run. Right? So that is just it. So price does two things when it gets to liquidity point. I want you to pay attention to that. It's either it sweep it, but then it retraces, or it runs it. It continues what? In that same direction, upward, without what? Retracing. Okay. Now let's take a look at this now. Now, this is where I want you to what? Pay much focus. What happens when price sweep liquidity? Because we are picking now. We are now picking what? Liquidity sweep. Okay. Now, when price sweep liquidity, what it does is that what it retraces back deep into what a fair value gap before it continues upward. I want you to pay attention to that again. When price sweeps liquidity, when price gets to liquidity point and it is being swept, so what it does is that price usually retraces deep into what? Into a fair value gap before it continues upward. Most times, there is usually a deep retracement back into a fair value gap on that same time frame. Now, look at it. On this same time frame, if this is 1 hour time frame, price will retrace back deep into a fair value gap that is being created along the way, you understand, when price was going after the liquidity, or a time frame higher. Okay, maybe probably if this is 1 hour time frame, then maybe probably after it has retraced, what it does is that it retraces back into that 1 hour time frame, the fair value gap on that 1 hour time frame, or a time frame higher, which might be what, 4 hour fair value gap, or probably daily or fair value gap, right? Now that is just that about that. Now let's take a look at some trades. Let's take a look at some trade. Now look at it. Look at this trade. This is a daily time frame, right? Look at it. This is a daily time frame. This is where the price is at the moment. Now, how do you know that this price is what, bearish? You don't know, but what gives you the assurance that the price is bearish is because of this fair value gap. I've taught you several times that what, fair value gap is the leg that price will use to move to the next destination. Now we have this fair value gap in the making, and we also have this what, swing low, which is liquidity point. So therefore this is a bearish price action. I want you to pay attention. This is a bearish price action. Now we want to trade from here towards this swing low, this liquidity point, you understand? Then after that, maybe probably this liquidity point. Now our what point of focus now is that when this price gets to this liquidity point, what happen? Price usually what, retrace back deep into what, into a fair value gap that it created along the way when it was coming down to peak liquidity. Okay, I want you to pay attention to that. Now let's continue. Now we have marked out our fair value gap as we have done before. Yes, as we have done before, we have mapped out the fair value gap. Now look at this. We have also mapped out our swing low, which is our what, liquidity point, where we are trading towards. Okay. Now there is a whole lot of money that resides on this liquidity point. So price usually moves from PD array to the next PD array. So the first PD array, which is the premium PD array, is your what, fair value gap. So it is this fair value gap we use as a leg to move towards what? Towards this swing point, which is your what, liquidity point on this daily time frame. Okay. Now what we are expecting price to do now is that price will tap into this fair value gap. You understand? Then this fair value gap will now push price towards this what, this liquidity point. That is our expectation. That is what price usually do. So now let's take a look at it now. Now this is what we are expecting price to do. Price comes into the fair value gap as a magnet. The fair value gap will now push it away as a rocket towards this liquidity point, right? As you can see that. So now let's take a look at what price eventually did. Okay, now what will happen is that after price has been rejected by this fair value gap, as price is coming down towards this swing low, this liquidity point, to come and peak liquidity, what price will do is that along its way down, it will create a new fair value gap on the same time frame, or maybe a time frame higher. That is why whenever you are trading, you understand, and you are targeting a swing low or a swing high or a liquidity point, you understand, you should always take time to look at what price is doing on the higher time frame too. So if this is daily, you understand, you should always look at the weekly to know if there is what, if there is a fair value gap in the making as price was coming down, or as price is coming down to peak liquidity. Okay, it is very important Okay, all of this can happen on any time frame. It does not really matter if it's going to be daily time frame. It can happen on 1 hour time frame, 4 hour time frame. Okay, but we are using this as a reference. Okay, now let's take a look at what price eventually did. Okay, now this is what is going to happen after the creation of this fair value gap here. You understand? As price was coming towards the this liquidity point, the moment price gets to this liquidity point and it has peaked liquidity, price usually retrace deep, you understand, into a fair value gap that was created along the way when price was coming to peak liquidity. That's why it is very important for you that when you are trading and you have been able to what, place an entry here, or maybe probably your stop loss is somewhere around here. Now you should target 1:2. 1:2 is more than enough to make you super profit, to make you super rich in this industry. Okay, 1:2, or probably you just target the next liquidity, because when price gets to the liquidity point and it has peaked the liquidity, it has peaked the money, price usually retrace. Okay, so now it is even possible that price will just retrace back into your entry level, or maybe probably it can actually take you out. You understand? So if you have entered here, now place your take profit on the liquidity point. You understand? After your take profit has been taken, you wait for price to retrace back into the new fair value gap that was created on that same time frame, or maybe a time frame above it. That's why you need to what? You need to pay attention to so many things whenever you are trading. Whenever you are trading on a particular time frame, do take time to look at the time frame above the time frame you are trading, to know what price is doing on that time frame. Okay, now let's take a look at what price eventually did. Can you see now on this price leg, price tapped into the fair value gap? Can you see it? It tapped into the fair value gap, then the fair value gap now rejected price. Can you see this bearish candle? It rejected price. This is where price is at the moment. So we are expecting price to what? To get to this liquidity zone and pick liquidity and pick money. After picking money, what it will do is that is going to sweep it and retrace deep. I want you to pay attention to that. Price usually retrace deep after it has peak liquidity. It will retrace deep back into a fair value gap that was created along the way. Now let's take a look at what price eventually did. Can you see? Now price has grabbed liquidity. Can you see? Price eventually got to what? Liquidity zone. Understand? After it has got into liquidity zone, it has picked the liquidity here. It has picked money here. Now our expectation now is that as a trader, you wait for a retracement, and that retracement is usually deep. That is what I'm teaching you this very moment. It's usually deep. Now let's take a look at what it eventually did. Now look at this now. No fair value gap created along the way when price was reaching for liquidity on this time frame. Now on this daily time frame, when price was reaching for this liquidity, as it was coming down, there was no fair value gap that was created along the way. Now it is expected of you as a trader to look at the higher time frame, the weekly time frame, to know if price has created a fair value gap on the higher time frame, or if there is a fair value gap in the making on the higher time frame. Okay, because you should know that after price has peak liquidity on this time frame that you are trading, price will reverse, price will retrace back into what? A fair value gap that is created on this time frame, or a time frame above it. Okay, now let's take a look at what eventually happened. Now this is our expectation. So we are expecting that as price has taken liquidity, there should be a deep retracement. Okay, after price has taken liquidity, most often price usually retrace deep into a fair value gap created along the way, or okay, when it was reaching for liquidity. Okay, that is our expectation. Okay, now let's take a look at this now. So can you see there is no fair value gap along the way on this daily time frame. But notwithstanding, let's take a look at the weekly. Look at the weekly time frame. Now, when price was, look at this now. This is the swing low here. Now that we have switched to what? Weekly time frame. Look at the swing low here. So when price was reaching for this liquidity, as price was coming down, there was a potential fair value gap in the making. Now, as a trader, as a smart trader, you should know that as you are on daily time frame and you are also checking for you are also checking the what weekly time frame. Okay, you should know that when price gets to this liquidity zone and peaks liquidity, price will retrace back because there is a fair value gap on the weekly time frame in the making. Okay, now that is just that is one thing that you need to what pay attention to. When you pay attention to this, trust me, you are going to be highly profitable. You are going to be highly profitable. Now let's map out the fair value gap on this weekly time frame when price was reaching for this low. Can you see the fair value gap? So it is expedient of you to know that what price will definitely retrace back to what to respect this fair value gap, because the moment price sweep liquidity, the moment price taste liquidity, it will reverse, it will definitely reverse back. All right, now let's take a look at, now this is our expectation, right? This is our expectation, price to what to retrace back. Now on this daily time frame, there is no fair value gap that price is retracing back to, but when you look at it on the weekly time frame, you should now see that what price will definitely retrace back to what there is a fair value gap that price wants to what respect. Okay, now that is just that about that. Now can you see, after price has peak liquidity, price retrace back deep, you understand, into something. Now if you have been on this daily time frame and you have set your stop loss somewhere around there, and maybe probably your take profit around here, and you discover that price has taken liquidity and it reversed back and tapped you out. That is because you do not understand the language of price. You understand? If you understand the language of price, you should know that when price takes liquidity, it usually retraces back deep into something, into a fair value gap. You would have been like, oh, there is no fair value gap on this leg anymore. So how come price retrace back? You understand? This fair value gap here has been mitigated. You understand? It has been used up because this is the fair value gap that we use to push price down. So this price turning back now, retracing back, is not coming to respect this fair value gap. Okay, it came to respect a fair value gap on the higher time frame, which is what the weekly fair value gap. Can you see that? It came to respect the weekly fair value gap. Can you see? Now it retraced back deep into the what? Into the weekly fair value gap. That is what we are talking about as a smart money what trader. Now let's take a look at what eventually happened. After it has respected the fair value gap on the higher time frame, and it is the fair value gap that now pushed price down. You would have been like, oh, there is no fair value gap here. How come price fell? How come price sold? But a smart money trader will know that, okay, it was what? The fair value gap on the weekly time frame that rejected price. Can you see a rejection, a rejection candle? So this fair value gap attracted the price, and when price got into it, it rejected price. Can you see? It rejected price, and the next move was what? Expansion down to the next um swing point after it has been rejected, you understand, by the fair value gap on the higher time frame. Now the fair value gap on the higher time frame will now push price to the next liquidity zone, which is this one. Can you see it? It went straight to tap the next liquidity zone. So that is what you need to know. It is very important that you understand that price usually retraces back deep into a fair value gap on that same time frame, or if a time frame above it. Okay, it is very important. Now let's take a look at the second trade sample, which is DSY. Now look at DSY. This is where DSY is at the moment, right? Now we are chasing after this liquidity high. Okay, now look at it. This is where our price is at the moment. So now we need a leg that can push price towards this liquidity point, and that leg is this fair value gap that is here at this moment. Now what are we? We are on what? We are on daily time frame, right? Now let's take a look at, let us map out our fair value gap. Now we want price to come into this fair value gap. The moment it taps into this fair value gap will reject it and push it up to the next liquidity point. Now, as you have been able to enter from here, you understand, on a lower time frame, because this is daily time frame. When price taps into your fair value gap on this time frame, you have to go to the lower time frame for your entry confirmation. The moment you are able to enter from here, your expectation, what you need to do is to target 1:2 along the way towards this swing point, or probably you target the swing point, okay? Because as you target the swing point, as price is moving towards your direction, as price is moving, you should be checking on the higher time frame or on this same time frame to know if there is going to be a creation of fair value gap as price is moving towards this swing high. If there is a creation of fair value gap, just know that the moment this swing high has been taken out, price will retrace back down to that fair value gap, okay? Then it is that fair value gap that will now the new fair value gap that was created on the way that will now push price to the next swing high or liquidity point. Now let's take a look at what price did. Can you imagine? So price tapped into this fair value gap. Can you see? It retraced back into this fair value gap. This fair value gap acted as a rocket. It pushed price away towards this liquidity point. Now, on the way towards the what? The swing high on this daily time frame, do we have a fair value gap that was created? No, there was no fair value gap. But you, as a smart money trader, you should check the higher time frame to see if there was or if there is a fair value gap that is created. Okay, now let's take a look at what is expected to do. Now, after price has taken liquidity, it is expected of price to retrace deep. So it is expected of price to retrace deep into a fair value gap that was created along the way when price was chasing after this liquidity point. This is what you need to know, and when you know this concept and you add it to your trading strategy, you are going to be profitable in the long run. Look at this now. This person that has been able to enter, this trader that has been able to what? Enter from here and target this swing high would have made maybe probably 200,000 dollars. Okay, now just take a look at this now. This is our expectation. Can you see? As price was going on this daily time frame, you should check what? The weekly time frame to see if there was what, or if there is a fair value gap in the making as price was moving towards the liquidity point. Can you see? There is a fair value gap in the making. So just know that the moment price gets to this fair value gap, there is going to be a retracement back down to this fair value gap. Then it is this fair value gap that will now push price towards the next liquidity point. You need to know that. Now let's continue to see what price is going to do. Now let us what? Let us map out our fair value gap on the weekly time frame. Can you see this daily time frame? Now on the weekly time frame, a time frame above the daily, there is a fair value gap in the making that has been mapped out. Now can you see it has been mapped out? So now let's take a look at what price did. Can you see price eventually tapped into the swing high, this liquidity point, and retraced deep into a fair value gap. You understand? A fair value gap. And that fair value gap, you don't know it, but look at it. When you go to what? To the weekly, a higher time frame, you will see it. Can you see? After it has tapped or after it has grabbed liquidity, or probably after it has swept liquidity, price came down to respect the fair value gap that was created along the way. Okay, so now it is this fair value gap now that will now push price towards the next liquidity point. So that's why it is very important as a trader, when you are trading towards liquidity, always know that, or when price gets to the liquidity point and it has peak liquidity, price will retrace back deep into what? into something, into a price leg, which is what? Fair value gap. Then it is now that fair value gap that will now push what? Price upward. Also note that when you are trading towards liquidity point, you should always watch out for what? The creation of what? Of a new fair value gap along the way on that same time frame, or probably on what? On a time frame higher. Look at this. On this time frame now, there was a fair value gap that was created along the way. There was, look at this daily fair value gap that was created, you understand? But there was a higher time frame that created a fair value gap. That fair value gap that was created on the higher time frame is stronger than this daily fair value gap. That is why price came down to respect the weekly what? Fair value gap. Okay, can you see that? That is that about that. Now eventually, when price retraced deep into the fair value gap, and what now happened? It pushed the fair value gap, pushed price to the what? To the next liquidity point, or to the next swing point, or probably you can also call it swing high. Let's take a look at it from the what? From the weekly time frame. Look at it. After price had tapped into the fair value gap, can you see an expansion candle? Price push the fair value gap, push price toward to the next swing high. So these are the things that you need to what? Understand as a trader. So if you've not subscribed to this YouTube channel, endeavor to do that, because the next video is going to open your eyes to so many things. It's going to open your mind to a whole lot. Forex trading is super easy, but you need to understand the language of price. All right, thank you.